there, I'm Mark Sebastian, founder of OptionPit.com, and this is an introduction to iron condors and iron butterflies, or better known as lifting off with iron condors and iron butterflies. So, for those of you that are new, let me tell you a little bit about myself. It's my favorite subject. So I was a floor trader on the American Stock Exchange and the CBOE for a little under a decade. Then from there I have started Option Pit. We are an education and consulting company. We work with, on the consulting side, we work with large traders and help them implement option strategies. On the individual side, which I suspect most of you are, we teach individuals how to trade like a professional, like myself. Additionally, I run a hedge fund called Carmen Line Capital that runs a volatility arbitrage strategy. So today we're going to talk about what is an iron butterfly or iron condor. We're going to talk about the positions in focus. We're going to talk about the conditions that make them fly and the conditions that make them crash. I'll discuss adjusting briefly, and then we'll look at building a fly or condor in a live environment. I'll pull up like live vol and we'll look at some ideas. So I've discussed this many a time. All right. Decay is exponential at the money. All right. It is linear somewhat out of the money and then takes forever once options become ultra cheap. I mean, that's really how it works, right? It's exponential at the money, linear somewhat out of the money, and then takes forever once options become ultra cheap. All right. So once an option becomes worth a dime, its theta just slows to a crawl. So, this is one that I've looked at in the past, and here's kind of at the money. All right. Here's kind of how out of the money options can look, kind of linear, and then they crawl. And then, in the money, this is kind of goes toward a value. But I think the big thing is to notice that at the money options really have a very different decay than in the money and out of the money. All right. So when properly set up, and they're usually not by people, butterflies and condors can take, iron butterflies and iron condors can take great advantage of decay. Really can. The key is proper setup of the trade. Again, gets screwed up all the time. All right, so now, briefly, let's go over what is an iron butterfly and what is an iron condor. All right, an iron butterfly is, in many ways, simply a straddle, a short straddle that is hedged. It involves the selling of an at-the-money call spread and the selling of an at-the-money put spread at the same time. You could also consider it selling an at-the-money straddle and buying an out-of-the-money strangle. The net creates a tightly defined high-yield area for the spread to profit from. So this is what an iron butterfly might look like. Old picture, but who cares? All right. You can see it's got a max loss, which is at the wings, and then somewhere between kind of where the strike price is, the at-the-money strike price, and where the wings are, tends to be kind of a break-even point. Pretty simple. So generally speaking, here's how we set these up. All right, and then we'll walk through setting one up. Generally speaking, set up an at-the-money iron butterfly with the wings set around one standard deviation out of the money. Think about 15, 20 delta on call and put. They should generally be set up inside of 30 days. They can use weeklies. They should be closed at a minimum of 3 days to expiration, and sooner the better. Don't carry these for a long time. And they take advantage of differing decay speeds. All right, so I'll walk through a setup now. So here is live vol. All right, and we'll look at, what? Did that thing come all the way back today? Wow. All right, so let's just look at SPX. Maybe we'll do SPY. This is going to be slow. There we have it. All right, so now let's look, and maybe we'll do the March 3rd weekly. One nice thing is they're basically daily options now in things like SPY. All right, so now, does everyone here know how to calculate standard deviation? All right. So, all right, just for those of you that don't, I'll run through real fast. It's real easy. All right, so I'm taking my at the money price, so 236. All right, I'm taking my, so I'm going to start with my days to expiration. So March 3rd is 10 days to expiration. So I'm going to do 10 over 365. I could also do trading days over 365. Then I take the square root of that. No. There's the square root. Then I multiply times the volatility of the kind of at the money, which right now is about, call it 9.5. So that's 0.095. Because remember, volatility is a percent actually. And then I multiply it times the strike price, which is 236. So we're talking about a $3.50 iron butterfly. So perfect. I'm going to do this a little different because it's sitting right in the middle here. It's up nicely after hours. And then I would 236, 3.5 points down is going to be 232.5. And this would be 240. Because 236.5 plus 3.5 is going to be 240. So then there's my butterfly. It's a 3.5 point wide. That's also split strike, and I collect about $1.83 on it. So if I pull up this up on a risk chart, kind of what it looks like. There's kind of what your trade looks like. So that's my butterfly. Real basics. Yeah. So I ended up buying the, in this case I bought about a 12 delta and about a 16 delta. So there you have it. Alright. So everyone understands how to do kind of the basic setup of setting up a butterfly. Good. Alright, so here's kind of some basic characteristics. Alright. The long out of the money put will typically have a higher delta than the long out of the money call, as we just saw, right? My out of the money call, even though it was $3.50 away, was a 12 delta. My out of the money put was a 16 delta. All right? That produced a negative delta, which usually iron butterflies will have. Isn't standard deviation available from the software? Yes, but that just for the same reason that you are required, that you make your kid learn to add 1 plus 1 and 3 plus 3 in his multiplication tables, even though we can do it on a calculator easy, you should know how to do standard deviation because it will help you understand what you're doing. I'm a firm believer that do fundamentals, then do the shortcuts. So, in my butterfly, you know what I want to point out. Look, widen that out a little bit. You can see this is a 16 delta. Meanwhile, my calls are a 12 delta. And that'll do it. 16.8. So then if you look at my risk chart on this, which I must have, I obviously have real positions on it too. My 10 lot fly starts out with a delta of negative 61. All right, now, because the shorts are closer to the money than the longs, it is collecting premium. If you're getting a net credit on an iron, you are long theta. All right. If you're doing a regular butterfly, even though you buy it, you are actually long theta. Butterfly, a call fly, and a put fly, and a iron fly are all essentially the same thing from a risk perspective. There's some subtle differences, but for the most part, they're the same thing. The spread wants the underlying to stay in a tight range. It wants it not to move. This is very important. So when you want something not to move, you are short what I would call realized volatility. You want the underlying not to move. That means you're short gamma. Those are the Greeks. And if you're selling premium, you are short vega. So you are short delta, short gamma, short theta, or long theta, short vega. So that is the basics of that characteristic. All right, so now let's talk about an iron condor. An iron condor is, in many ways, simply a strangle that is hatched. It involves selling an out-of-the-money call spread and selling an out-of-the-money put spread at the same time. Creates a wider landing pad of safety. I like these when they're a little more forgiving of some realized volatility than an iron butterfly are, but they're actually maybe a little worse for vega. On a raw number. So that's kind of your basic iron condor. All right. So now let's set one up. The further out, so as you know, or maybe you don't, the further out in time, the further out of the money options decay. Oh, you do know this because we talked about it earlier. All right, but maybe you forget. The further out of the money options decay more linearly. All right. So what's interesting is an option that is 10% out of the money will lose more dollars from day 60 to day 30 than it will from day 30 to expiration. All right. So really, when I'm setting up a kind of higher probability iron butterfly, all right. So really, when I'm setting these up, I'm looking for 60 to 70 days to expiration at around a 10 or 11 delta for my shorts. Typically is going to be about 10% out of the money. All right. And I set them up from the most favorable strikes from a skew perspective. All right. And really, open interest doesn't matter. Guys don't care. They really don't. I think open interest on the entirety of the contract matters. So is there a lot of open interest in the entire contract? But open interest in terms of is there a lot of is there a lot on that specific strike? Does not. So let me show you what I'm thinking. So here's SPY, and let me show you its stats. So it has an average open interest of 20 million contracts and trades 2 million contracts a day, 2.5 million. All right. Then there is Deutsche Bank, or let's pick something kind of, all right, IYT, the Dow Jones Transpose. This has a total open interest of only 5,000 contracts and a daily average volume of 700. So it's going to be hard to get anything filled in this because there's nobody trading it. All right, if something's liquid, it's liquid everywhere. If something is illiquid, it is illiquid everywhere. All right, does that make sense? All right, in my pension account, don't ask me why, I can't sell short any calls. I can sell puts short or naked, but not calls. Is there a downside to me doing long butterflies or condors using puts only compared to puts and calls? It's not the end of the world. I'm sure there are some individual things that are, some small intricacies that can make it slightly more difficult, but I don't think that's a deal breaker. All right. But again, I'm not a financial professional. I'm an educator. So consult your financial professional. They may be able to give you more information on that. So here we are. It is February 21st, or February 23rd. 60, 70 days out, we're talking kind of the May 5th contract. A different definition there. All right. So, all right. So now let's look. Here we are. Here's the S&P 500. We're in the May 5th contract, which has 5 days in May, 30 days in April, 31 days in March, and 7 days in, or 5 days left in February, right? February ends on the 28th. All right, so we're talking about a, call it a, call it 70 days, or 71 days. That's perfect, okay? It'll be 70 tomorrow in terms of the way I'd be doing these. All right. So I kind of look around and I've got, let's see, I'm looking at this 24.8, 24.90 as a spread, or the 24.75, 24.80. I almost like, look, I almost like this one better. Doing a $5 wide. I'd rather do $5 wide than 10. All right, and that's because of curvature. I'll show you what I mean. All right, now let's get down to my deltas on my downside. Boy, that kid's unhappy. So I'm going to be looking at the 2175, 2170, or the 21. So here's kind of some interesting thing. Here's an interesting thing. So let's look at what they are. So if you look, there's some little intricacies. So if I do the 2170, 2175, I'm looking at potentially getting about 35 cents. If I move it really $5 closer, I get an extra nickel. This is 40, 40. If I go down if I go down $5, which is nothing in the S&P, I lose a nickel. So I might set my iron condor up like this. So you can see I'm getting about 90 cents on a 5-point wide fly. All right. Now, why would I rather do that than the 10-pointer? Well, let's take a look. So I'm going to set the 2185, excuse me, wrong one, 2180 versus the 2170, and then, oh, there's no, all right, well, we'll do the 70, 80. So I got about 196. Now, I did move it slightly closer. So let's look at just the 70.75 versus the 75. Right, so this spread gets $1.06. I'm doing the 70.75, 75.70. Right, I'm selling the 24.70s and the 21.75s. I'm buying the 21.70s and the 24.75s. I get $1.06 out of that spread. Call it $1.05, maybe $1. We'll give them something. Now, if I widen this to $10 wide, I get $1.90. So what would I rather do? Get a dollar or a dollar? Would I rather get $1 20 times or $1.90 10 times? Well, would you rather collect $2,000? Yeah. Or would you rather collect $1,900? Yeah, absolutely. And you might say, well, you're giving up a little. What about commission? If your commission costs you more than the extra amount you're making on that getting the dollar, you need a new. Your broker's charging you too much. You're getting screwed. All right. So now, let's look at the risk chart on that. We'll go out 8 weeks. And you can kind of see what it looks like. Here's it getting pretty close to expiration. And there's my iron condor. Not a bad little spread. So I'm trying to make 1,000 against 4,000. All right. Personally, I don't do a lot of iron condors. I don't like them that much. There are people that swear by them. Yeah, I'm sure it's great, but I'm guessing that that there are some, it's a little dirtier than that. It's costing you more than you think. But I haven't looked at the platform. And actually, you should be able to do better than a dollar round trip. So I don't consider 50 cents a side particularly cheap. But I do like the idea of not charging for closing. All right, so what is cheap? Really, you should be able to do, if you're active, I think you should be able to pay between 25 and 40 cents a contract. If you're active. All right, so a short iron condor is generally going to have, it's got very similar characteristics to a butterfly that is just duller. So again, it's going to have short delta caused by skew. Puts are, puts have this curvature, so there's less long delta coming from your puts than there is short delta coming from your short call spread. So that creates a short delta. All right, so if you look, all right, if you look at my SPX here, my delta on my call spread, on my put spread, is essentially 0. My delta on my call spread, though, is -1. That produces a delta that's slightly negative. Now, because the shorts are closer to money than longs, obviously you're collecting theta. The spread wants the underlying to stay in a tight range and not move. So the spread is short gamma. When you want something not to move, you're short gamma. All right. And the spread is selling premiums, so it's short vega. So now let's talk about the keys to success. All right. Notice both the iron condor and the iron butterfly have some characteristics that are the same. They're short delta, short gamma, short vega, and long theta. They basically have all the same characteristics. But just because something is similar doesn't mean it's the same. Think of them as fraternal twins. Does that make sense? Yes, similar characteristics because you're selling premium, but very, very different. Like I've got an older brother. People think we look alike. We do not act alike. I am awesome and cool, and he is a complete jerk. I'm kidding. My brother is awesome. I love him. So now let's focus on the differences between the two. So they share similar characteristics but are not the same trade. Why? Because changing Greeks with the respect to the inputs, all right? Changing Greeks with respect to model inputs, as the inputs in the model change, the way the Greeks change is entirely different. So I want you to look at this butterfly. All right, and I want you to notice these Greeks. Short 51 deltas, short 36 deltas, long 54 theta, short 36 vega. All right. This is obviously an old chart. All right, now here's the iron condor in apple. Same thing. Definitely a different delta. slightly less short gamma, similar theta. Look at that. Very similar thetas. And then the vega, you're short a little more vega in the butterfly. So an iron butterfly or an iron condor will perform well when implied vol is falling. So you're looking for falling implied volatility. It is a terrible sale when implied volatility is climbing. All right, butterflies in particular are not a trade that you are looking to do when implied volatility is climbing. You can maybe get away with an iron condor. But I love selling butterflies into a falling implied volatility. When implied volatility and realized volatility are trending down. So I want you to note the dominant Greeks. All right, a lot of people think of these as, you know, oh, I'm an income trader. I'm trying to collect the premium. I'm going to sit in these for 15 days and I'll make money. Really, if you're smart, you can be in these trades for 3 or 4 days or a week, not 2 or 3 weeks. Because theta melts. Vega, you know, the volatility component cascades. It's like a landslide. It's like a rushing river. I think that's the Hoover Dam there. All right, so now here's the two trades. All right, and right now we're looking at the iron butterfly. All right, and what I want you to notice is that, you know, we've moved the dates a little. All right, probability is 9/20. This was 9/9, so this is 11 days passing. You see that? All right, it's 9/9, 9/20. So you can see you made money on that theta. Meanwhile, same date. Look what's happened. The theta in the butterfly is about the same, maybe even up a little bit. Your gamma's gone way up, and your vega's gone way up, and your delta's moved around. Now, let's go my iron condor. What's happened? My gamma's gone up a little bit. My theta's actually fallen, and my vega's fallen. Or about the same. So my butterfly, a little more risk, same theta, more short vega exposure. My condor, similar risk, but less decay. So the lesson here is, you know, if you play it right, you get out quick on these two trades. Really, you're not picking up a lot of theta. You're not getting increasing burn. You're getting decreasing burn. All right, and your risk is going up. Would a butterfly be a good trade the day before earnings? No. Those are some good questions. I hate earnings plays. I think they're a crapshoot. And actually, they're statistically a crapshoot. So note the differences between in the gamma and the vega of the two positions. Both want the two Greeks to decline, but one is much more aggressive. All right. One is much more aggressive. All right, as time passes, my butterfly gets super aggressive with volatility. My condor actually gets less sensitive. So now the final piece is that you want HV to be falling as well as IV. One result of high IV is really high HV, really high movement. So part of the reason that I don't like selling high implied volatilities is because really that typically means the stock is moving around. All right. So I'm looking for a stock to stop moving. I'm not looking for it or to slow down. I'm not looking for it to increase. All right, so now, here's a condition that I won't do butterflies or iron condors. Maybe an iron condor, but not a butterfly. So this white line is 10-day realized volatility. So it's how much the market has been moving the last 10 days. All right. The red line is 30-day implied volatility. So really, the red line represents kind of where is implied volatility, and the white line represents how much are things moving. So what Greeks affect the iron butterfly and the iron condor? So I think in general, it is as soon as your major risk becomes delta for an iron butterfly or an iron condor for that matter. So when you are really paying attention to the direction of your butterfly or condor, of the underlying, you're probably not going to make money on your butterfly. All right, so as implied volatility increases, and this is important, it can make time stop in a butterfly or a condor. The sale price and vol levels are very important on these two. So when implied volatility explodes, Vega can become a problem as the fly or the condor will not collect theta, and the trader still has to deal with gamma. I mean, that's a huge problem. So, let's just real briefly what I'm going to put in vol shocks. So this is a 10% increase in implied volatility. All right, or a 20% increase and decrease in implied volatility. So what I want you to notice is that if volatility increases 20%, I lose $300. Well, I'm only making $11 a day. All right, so if implied volatility increases that much, look, it's been a week or 5 days and I haven't made money. Look, I need to make it basically on this iron condor. I basically need to get to the middle of March to make back what I gave up in implied volatility. Okay, that's really important. All right, so the big decision is a trade-off in duration. All right, I like iron butterflies for short duration trades that concentrate on tiny amounts of IV erosion. All right, I like to think of butterflies as kind of hitting someone who's really much bigger than me, and hitting them in the crotch once. All right, so if somebody's way bigger than you, all right, and they're beating you up, or they want to beat you up, you punch them in the crotch and you run as fast as you can. All right, that's just like an iron butterfly. All right, Whereas an iron condor, it's got a lot more tolerance of stuff. It can handle a lot. It's a bigger trade. All right, it's a much bigger dude. So it can take a lot of punishment. So they're longer duration, further away from the money, and it's when there's a chance that movement might kick up, or if movement's been kind of choppy. They're great. They're great for chop. So like oil, iron butterflies look great for oil right now, in my opinion. All right, so now let's just talk about basics of adjusting, real basic. For butterflies, I really like to use single options, buying calls or buying puts, to manage delta. All right. For weekly options, I typically put them on, and then if they don't work, I take them off, or I'll slowly remove the side that's being hurt. That's the other adjustment that I'll do. So if I've got a butterfly on and the underlying is rallying, I'll slowly buy back call spreads. All right. Now, never throw money at a trade. One of the things I see out there, and it's super dangerous, is I see these guys preach, put on $5,000 worth of iron butterfly, then add, if things go your other way, throw another $5,000 butterfly on to fix it. And if it goes the other way or keeps going, throw on another $5,000 trade. Well, what have you done? You've just turned a $5,000 trade with limited risk into a $15,000 trade. It's not something to mess around with. All right, that is how you take a trade with limited risk and turn it into an account bomb. All right, never throw money at a trade. Every trade that you do should be an attempt, especially with adjustments. All right, every trade that you do should be looking to reduce margin, or at a minimum, add very little. You might be adding a little bit of margin if you buy a call option, but we really aren't. All right. I mean, what if that is part of your planned capital for the trade, as you can't time your entry perfectly? So I've never seen that work over time. All right. If you are analyzing volatility and analyzing realized volatility, and just buying and selling call options, or taking the wing side that's getting damaged off, that is far more effective than doing that. I would rather, if I really like a butterfly, which is when I do butterflies, right? I do butterflies when I really like them. All right. If I really like a butterfly, I'd rather do $10,000 now than plan on putting $15,000 trade. So, and here's the other problem with that. All right, planned capital. So what if your trade goes really well? All right, well now, out of a $5,000 of margin, you need to try and return 10, 15% on $15,000, on what is $15,000 of capital. Instead, put that 8 or 10 grand at work, and if you're doing your job right, get in and out, and then manage it with call and put options. That's the way to do it. I just think putting aside capital for adjustments is how people keep brokerage houses in business and never make money. All right, so for a condor, one could consider using a kite spread for a rallying condor and a put spread for a sell-off. All right, for a tight iron condor, remove the pieces as delta moves around, just like a butterfly. If iron butterflies are not good for earnings trade, what do you use for earnings trade? I don't do earnings trades because they are a crapshoot. All right, I am great at trading volatility. When you add earnings in, very rarely is there a volatility edge. I'll show you. All right. The question is, what is a kite spread? It's something I talk about in my book, you know, we managed. We had a big Apple spread that we did, a split strike trade that went really well from a while back. But I'll show you. We've done a lot of butterflies. Andrew's my number 2. He and I tend to do a lot of butterflies and calendars and not that many condors. So in summary, and then so let me get through the summary and the offer, and then I'll walk through straight up analyzing, you know, a 3-minute analysis of a condor and a butterfly and what would make me take them on. So IVs and ICs take a lot of work. Understand what the IV is going to do. Learn to control the gamma by understanding the difference between intensity of the position, and learn to sell declining realized volatility. All right, so now, March 11th at 9:30 a.m. Eastern Time, we are doing our butterfly intensive. All right, so this is going to be 3+ hours of butterfly training. All right, we're going to really dig more into butterflies and iron butterflies. We're going to talk about risk control. We're going to jump into adjustments. I'm going to spend a lot of time on finding good trades. We're going to talk about trading short weekly spreads, and we're going to talk about trading the big monthlies, because we do a lot of weekly stuff. I'm going to show you some modified things that we do. All right. And we're going to talk about how to do directional butterflies, and actually I'm going to talk about short butterflies, another trade we like doing. And the goal is for you to manage risk in these spreads so that you can create income. Now, what's the number one way to manage risk? What is the number one way to manage risk? Cut losses quick. Incorrect. Trade small. Incorrect. Stops. Incorrect. Taking trades, position size, stay in cash, all great ideas. The number one way to manage risk is to put on really good trades. So guys who are good traders don't put on bad trades very often. And when they do, you're right, they cut losses quick. Can never go wrong staying small at order on a trade. Unless it's a really good trade, then you are wrong. And you can never grow an account by being afraid to put on a real trade. All right? And I'm not messing around. Typically when I put on a trade in the fund, I'm doing between 1 and 5,000 contracts, or 1 and 5,000 spreads. All right. So you're going to go to optionpick.com/flies, and you're going to use, and it's, you know, when we put it in our store, all right. So if you go to the Option Pit website, all right, and then I'll look at some trades. All right. You go to the Option Pit website, you look at events. Here's where it is. Also, I will post the new replay right here. But when I put this in my store, this is going to sell for $350, the recording. Okay? You can watch it live for $177, and if you use code 25_off, all capitals, you take an extra $25, so it's $152. So basically, you're getting it for, you know, 60% off if you sign up by Sunday. You go to optionpit.com/flies, and if you hate it, If you go through it and you hate it, then I will come up with a way to rectify the situation. Either give you your money back, or I'll give you another class that maybe fits you better. All right, but this is going to be intensive. All right. All right. So now, any questions on the course itself? All right. So let's start with something that might be a good iron condor. So here's what I'm looking for. Is this mentorship only one day? Yes, it is. It's one day. If you are an Option Pit Live subscriber, it's included with the subscription. And just an FYI, the subscription is $125. Send me an address. Or confirm your address. And yeah, it's a one-day class. You get to keep the recordings and the materials. But it's pretty good. You're going to be pleased. All right, so let's look here. I'm going to pull up, I have the benefit of LiveVol here. And this is where, so I pay less than that Tastyworks, and I have a better platform with LiveVol X. So I'm going to look at IVHV, and I'm going to look, this is like a fun little one I'll do. This can be really good for iron condors. And I want one where IV is greater than HV. So IV 30, so implied volatility 30 days out, is greater than movement over the last 30 days. And we get one that's interesting. And that's Alta Beauty. We also see Palo Alto Networks. All right. And you can see there's some stuff here. So let's look at, I'm not going to do stamps.com as much as I love stamps.com. Alta Beauty, Palo Alto. Best Buy has earnings. I don't want to mess with that. Alta Beauty has earnings in March. Let's look up, I got to find one that isn't. Some of these are. Palo, there's a minimum of average 1,500 contracts a day. Someone told me that ES rather than SPX strikes are further away from the underlying for the same credit amount. Comment, please. I've never heard that. Red Hat. So they've got earnings coming up. So now, obviously, I'm looking for earnings to make sure I don't get caught. Navarro, they had earnings today. Kite Pharma. All these have earnings. Dust. All right. Here's one that's interesting. Gold miners. Dust. So let's look at Dust. That's a nice high implied volatility. And look at that movement. So I've got super high IV. So this is a butterfly candidate because it still has super high realized volatility. And it's got high IV. So I would probably look at this as a potential condor. It's been in a range. $28. So I would look at this as an iron condor trade, potentially. That's a little wide there. Let's see if I can find something that has relatively tight markets. So you can get things done in Dust. It's obviously not the most liquid, but maybe like, well, let's try and put something together. So I would look at this, and if I go out to April with this high implied volatility, check this out. I mean, I can sell the 45. Man, this is a decent Condor. I can sell, so this is a little tighter, so I'll bring it a little closer. So I can sell, let's just say the $20 away. I can sell the 42.45, or the 42.44. All right, and then I mean, if you look at downside, that's unbelievable. I mean, this is going to have. I'm going to have to bring the calls closer to get the delta somewhat under control, but not much. I'm looking at this IV, and we'll do the 40.42. That should work. I like that. So a name like Dust. Now, obviously, this is a little wide. But as an Iron Condor, man, this is nice. All right. Another one that I talked about was USO. I think USO has been choppy, super choppy. Let's take a look at this. Very little movement, huge spread between implied volatility, lots of chop. So I might set this up as like a split strike butterfly or an iron butterfly. So let's just look at March. And right now I'm not getting data on this one. Oh, there it is. Let's look at like the March. Jeez, 11.5, 12, 12.5, 11. That's not a bad looking iron butterfly. Collect 34 cents to risk 15. And the movement, while it's been choppy, it's been pretty range bound. I mean, let's just look at price here. This thing has been basically stuck between 11, been below 12. Here's 1180. Still inside of my fly. Been essentially below that since January 6th. And then here's 11, or 11.14. It's kind of touched that on an intraday basis without closing there. It's closed there once. No. It is legitimately not closed below 11.15. Since January 10th. It's an interesting butterfly candidate and super liquid. So that would be one I would be very interested in trading. 34 for a 50-cent fly is pretty cheap. Yeah, Greg. Yeah, that liquidity isn't very good. And yeah, isn't that delta too high, the 40.42? Yeah, but that's because the volatility is so out of whack in Dust. So I agree. But 34 cents on a 50-cent wide spread, that's more than fine. You know, or I could do it a buck wide and I end up getting, you know, 50. This isn't bad either. You want wider? You know, I could do a buck wide and then I'm collecting almost 50 cents. And then if I look at my chart, my daily chart, you know, when was the last time it was below 11? Last year. When was the last time it was above 12? Has not closed above 12 in over 6 months. That's a good looking butterfly. I may actually put that on the strategy letter. So if I start, let's talk about this 47-cent one because I actually think I like that better. If I start with 47-cent credit, I'm looking to make about 20 or 25 cents. $0.34 credit, probably 15 to 17. All right. Okay, folks. Again, I want to thank everybody for coming. Go to optionpit.com/flies, get yourself signed up, use that code, and yeah, 50% or so. It's about right. As much as I can. Once I see the volatility start to increase, I'll typically take it off. Bad idea. All right, folks. I hope everybody has. No, I don't. Do I always target a certain percentage? No. You know, typically about half is what I'm gunning for. All right. And we're going to dig way deep into that, really setting up targets, really evaluating when to get in and get out on these things. So I just spent 5 minutes. We're going to spend 3 hours on just building these things. All right. So if you got questions, you can email me, mark@optionpit.com, or you can call me 888-TRADE-01. Or, you know, info@optionpit.com works too. All right, folks. Hope everybody has a great day, a great evening, and I'll talk to you soon.